And then I wrote back, I think the FDIC report about credit quality is behind the times, and I do not trust it. I think they're overly optimistic. So he writes back, I think that's a fair read. The FDIC report is not useless, but it is absolutely a lagging comfort report, not an early warning siren. It's built from bank reported quarterly data, and the FDIC describes the quarterly banking profile as an overview of FDIC insured institutions' aggregate condition, earnings, loan deposit activity, asset quality, and related measures. That means it's great for confirming stress once it has entered bank books. It's weaker for detecting stress when it's still forming in households, shadow credit, CRE refinancing, appraisals, extend and pretend, or loans not yet recognized as impaired. So yeah, when the FDIC says asset quality is generally favorable, I hear the official banking aggregate has not yet admitted a broad credit problem. Not there is no credit problem forming. Those are very different claims. The current official bank delinquency rate does not look calmish on the surface. Q1 2026 all bank delinquency rates were 1.48 for total loans and leases, 1.73 for real estate, 1.89 for residential real estate, 1.76 for commercial real estate, 2.46 for consumer loans, and 2.29, sorry, 92 for credit card. But that is precisely the kind of data that can look, quote, manageable until a credit cycle rolls over harder. And the household side already looks less pretty. The NY Fed said that 4.8% of outstanding household debt was in some stage of delinquency in Q1 2026, with mortgage serious delinquency transition rising slightly, while auto and credit card serious delinquency transitions were mostly unchanged. So I'd frame it this way: the FDIC report, bank balance sheet damage already visible. NY Fed household debt equals borrower stress forming. MBA mortgage data, housing loan stress by channel. FRED delinquency charge off data, confirmed deterioration. Bank provisions equals management quietly preparing for losses. Bankruptcy slash repossession slash foreclosure stress is becoming forced liquidation. Your suspicion is especially reasonable because bad credit does not show up all at once. It usually migrates through stages. Payment strain, minimum payment slash revolving balances rise, delinquencies tick up, modification slash forbearance slash extensions, non-performing loans, charge-offs, collateral repricing, bank provisions spike, lending standards tighten. The FDIC report mostly catches the later middle part of that chain. You're trying to detect the earlier part. That means our watch list should treat the FDIC as confirmation, not forecast. The better early warning dashboard: credit card utilization and revolving balances, why it matters. Households are using debt to maintain consumption. Early stage delinquencies, 30 to 60 days, stress before full default. Auto delinquencies and repossession, lower middle income borrow cracking. FHA slash VA mortgage delinquency, weaker housing borrowers cracking first. HELOC drawdowns and delinquencies, homeowners pulling equity for cash flow. CRE maturity refinancing failures, collateral plus rate stress, loan loss provisions, banks preparing for pain before charge-offs. Charge-off losses are becoming real. Bankruptcies, household business balance sheets breaking, lending standards, credit machine tightening before defaults peak. The big danger here is not one sick category looking ugly. It's synchronizations, cards, autos, FHA mortgages, CRE, small businesses, HELOCs, and provisions all deteriorating together at the same time. That would mean stress is spreading through the balance sheet system rather than staying isolated. So it's an everything bubble. So yes, keep the FDIC data, but demote it. The FDIC is the rear view mirror. Delinquencies and provisions are the side mirrors. Utilization, refinancing stress, and layoffs and forced sales are the windshield. Tiny Goblin version. The FDIC report tells us whether the body is already on the floor. We need to watch the pulse before it drops.